Welcome to this month's Market Update. I'm joined today by Alexandra Veroude, Senior Consultant with Frontier Advisors, Capital Markets and Asset Allocation Team. Hi there, Alexandra.
Hi, Wayne. Fantastic to be with you.
Well, it's certainly been a volatile month for markets, primarily based around US trade policy, as I think the entire world knows. Why don't we start on our review of the month that was in the US and specifically, I guess, a focus on equities markets.
Sure, 30 days has almost felt like 90, but here we are closing out April, and I think that this month will likely be remembered for some time. So looking at the US, we saw the MSCI US index actually shed around 12% in the days following President Trump's April 2 tariff announcements. The sell-off was most pronounced in tech names, but really broad-based across sectors. Investors returned as some of the more aggressive tariffs were delayed several days later, but the US index is still slightly lower over the month, although it has been rallying as we move into month end. Market sell-offs are painful, but we really should view this recent sell-off in context of the broader rally that we have seen in US equities over the past year or so, and must remember how stretched valuations of some of the tech names in particular had become. Amid the equity market sell-off, the US dollar was also out of favor, with investors instead preferring the euro, Japanese yen, and Swiss franc, each appreciating around 5% against the USD.
Now, bond markets have been interesting. Typically, we would expect investors to perhaps pivot toward bonds during an equity sell-off.
Yes, so typically you would expect to see bond yields move lower during a sharp risk-off period, with investors fleeing to this perceived more conservative asset class, bidding up prices and lowering yields. But contrary what would be expected during an episode like this, bond yields in fact spiked. They eased at the beginning of the sell-off, but spiked in the middle, and this was reported to be associated with liquidity reasons around a particular group of investors needing to sell treasuries quickly to fund other positions. It may have also been associated with a broader market aversion to US debt. However, it is this spike in yields, which ultimately increases the cost of US debt, is what pulled in the US president to delay the largest of the announced tariffs. And this brought some calm back to bond and equity markets. And nominal yields are now lower across most markets in the month.
So, what have we seen from the US Federal Reserve, both in terms of what they've had to say, but their actions as well?
Yeah, so the Federal Reserve FOMC committee did not meet over April. Their next meeting is in fact scheduled for early May. However, Fed officials have been stressing the complexity of managing their dual mandate, which is both price stability and full employment. And this is as tariffs are expected to lead to higher inflation, while simultaneously uncertainty and around the significant changes to trade policy are expected to weigh on the domestic economy. Chair Powell has continued his messaging, adopted at the beginning of the year, that he is in no rush to react. But however, we saw the central bank was at the center of a renewed set of market turbulence later in the month as concerns escalated about the future of Fed independence. Again, the president here needed to speak up to reassure markets that he does not intend to interfere with the independence of the central bank. However, the president has not shied away from voicing his opinions about his desire to see interest rates lower, and this current steady stance of the Fed is at odds with that. But we are seeing futures markets, they're suggesting that rates will be lowered multiple times over the rest of the year.
So, while the activity's been emanating from the US, it obviously has flow-on effects around the globe. Step us through some of the impacts in other markets.
Yeah, sure. So the April sell-off certainly was not concentrated in the US. We saw risk assets globally sell off, with indices across Europe and Asia all experiencing declines. Now, if we focus on Europe, we've seen European equities, while they're still lower over April, they're higher since the beginning of the year. And this has been supported by the broader rotation away from the US and an optimism of stronger regional economic growth from greater fiscal stimulus. We've also seen the European Central Bank has been supporting the economy, and it lowered its benchmark interest rate by 25 basis points in April. And in fact, this is the 7th time it has lowered interest rates in the past year. And further rate cuts are expected. And while the central bank is noting that downside risks to growth have increased.
And so if we move east toward China, another pretty big player.
Yes, so China has certainly been center of attention among these trade tariff escalations. So while we saw some of the more aggressive tariffs delayed, China is still facing significant tariffs on its exports into the US. So we saw Chinese equities sold off sharply around the tariff announcements. However, policymakers have been encouraging local investors to buy local equities, and indices are up around 9% since April lows and a similar amount over the year. And this has also been boosted by optimism in the tech sector, which gained momentum around the DeepSeek announcement earlier in the year. Policymakers are also expected to provide additional stimulus to support the economy that was already dealing with this overhang from property sector weakness even before these trade tariff escalations. But authorities have said that they are still confident in reaching this year's 5% growth target.
All right, and let's finish our focus back here in Australia. How have markets reacted domestically?
Yes, so it's been really interesting in Australia. Australian equities had been out of favour, in fact, since the beginning of the year. But investors have returned since the broader the broader mid-April sell-off. And in fact, Australian equities are ahead over the month, led by gains in financials. The Australian dollar has also recovered after falling below 60 US cents amid the market turmoil, but is still low against the US dollar over this financial year. And if we think about the domestic focus in the month ahead, it'll be on the federal election and the Reserve Bank of Australia meeting in the middle of the month. And futures markets here are also expecting that further rate cuts over this year. Certainly been a busy month.
It has been a busy month, a very interesting month as well, and probably reinforces the need for good advice and analysis at a time like this to manage investment portfolios. Thanks for your update, Alexandra, and thanks for joining us for this month's market update.
See you next time, Wayne.